The numbers on paper are almost perfect. Unemployment is low, wages have technically climbed, GDP continues to tick upward with reassuring precision. Yet, if you sit in a car in any suburban parking lot at 7 p.m. on a Tuesday, you will witness a silent, ubiquitous ritual. A driver staring at a phone screen, calculating the exact sequence of bills that need to be paid versus the exact date of the next direct deposit. Something fundamental has broken in the mechanics of daily life, but it hasn't broken with a loud crash. It has broken like a slow, unraceable leak. Millions of households are living inside a financial paradox. They are fully employed, they are doing everything right, they don't buy luxury goods, and yet they are perpetually operating on the razor's edge of insolvency. The central mystery of the modern economy isn't why people are poor. It's why people who are doing everything right feel like they are constantly sinking. Consider a single, terrifying statistical anomaly that macroeconomists rarely discuss on cable news. Over the past 5 years, personal savings rates have collapsed to near historic lows, while credit card balances have crossed the $1 trillion threshold for the first time in history. But here is the open loop, the catastrophic mechanism hiding underneath that data. This isn't a story of consumer greed or reckless spending. The middle class hasn't changed its behavior. The rules of the baseline have been silently rewritten. We have entered an era of phantom prosperity. When headline inflation metrics claim that price increases have cooled down, the public assumes relief is on the horizon. But cooling inflation doesn't mean prices are falling. It simply means the fire is consuming what's left of your purchasing power at a slightly slower rate. The high prices set during the crisis didn't reset. They became the permanent foundation of reality. The ceiling instantly became the new floor. If a family's recurring monthly expenses surged by $600 over a 3-year period, a drop in inflation to 2% doesn't return that $600 to their bank account. It guarantees that the new, inflated price point is here to stay, forever. Every single month, that $600 is extracted from the same baseline salary. Multiply that mathematical reality across housing, vehicle insurance, property taxes, basic groceries and medical copays, and you begin to see the architecture of the trap. Between 2021 and 2026, average hourly earnings grew, but real wages, the actual volume of goods and services those dollars can command, remained functionally flat. Workers received raises that were immediately neutralized by the invisible tax of compounding baseline costs before the money ever touched their accounts. You work the same hours, you receive a larger number on your pay stub, and yet your disposable buffer shrinks. This creates a psychological phenomenon known as structural financial exhaustion. It is the persistent, low-frequency hum of anxiety that accompanies every transaction. It isn't the fear of bankruptcy. It is the realization that there is no longer any margin for error. A minor vehicular repair, a cracked tooth, or a higher-than-expected utility bill during a cold snap isn't just an inconvenience. It is a systemic shock that detonates a carefully assembled financial ecosystem. The system is no longer built to allow households to accumulate capital. It is designed to extract maximum liquidity while keeping the workforce just comfortable enough to keep returning to work. The true crisis of our time isn't a sudden collapse. It is the permanent loss of the cushion that once defined a stable life. And to understand how we got locked into this high-cost, zero-margin cage, we have to trace the deliberate policy decisions and geographic traps that built it. To understand how the American middle class was pushed into this high-cost structural trap, one must examine the specific regulatory choices, monetary interventions, and geographic bottlenecks enacted over the past 2 decades. The current financial squeeze is not an accident of nature. It is the calculated result of specific legislative frameworks, urban planning failures, and institutional capital shifts that began long before the recent inflationary spike. The structural foundation of the housing crisis was laid in the immediate aftermath of the 2008 financial crisis. Following the collapse of the subprime mortgage market, residential home construction in the United States plummeted to historic lows. Between 2009 and 2019, American home builders produced fewer single-family homes than in any single decade since the 1960s. This decade-long construction deficit created a cumulative shortfall of roughly 5.5 million housing units across the country. While supply was artificially suppressed, demand was deliberately inflated. The Federal Reserve held its benchmark federal funds rate near zero for over a decade, injecting trillions of dollars of liquidity into the banking system through successive rounds of quantitative easing. This policy lowered mortgage interest rates to unprecedented levels, culminating in the 2 to 5 to 3 to 0% range observed between 2020 and 2021. Capital exiting homeowners locked in these historically low borrowing costs, anchoring their housing expenses at artificially reduced levels. However, when the Federal Reserve aggressively raised interest rates in 2022 and 2023 to combat surging consumer prices, bringing mortgage rates above 7.0%, the market froze entirely. This created the rate lock effect. Homeowners holding 3 to 0% mortgages refused to sell, knowing that purchasing a similar property at current rates would double their monthly payments. Consequently, the inventory of existing homes for sale dropped by more than 40% compared to pre-pandemic baselines. First-time buyers were immediately caught in a geographic and economic vice. According to data from the National Association of Realtors, the median price of an existing home reached $410,000 by 2024, while average monthly mortgage payments for new buyers doubled relative to 2019 levels. In major metropolitan areas, purchasing a median-priced home now requires an annual income exceeding $115,000, effectively pricing out more than 60% of American households. The pressure rapidly spilled into the rental market. As millions of prospective buyers were forced to remain renters, corporate institutional investors stepped into the void. Private equity firms and real estate investment trusts, capitalized with low-cost corporate debt, purchased tens of thousands of single-family homes across the Sun Belt and suburban corridors. Companies like Blackstone and Invitation Homes acquired large inventories of starter homes, converting them into permanent rental properties. This institutional purchasing power further inflated home prices, while concentrated rental market ownership gave landlords enhanced pricing power. Average residential rents nationwide increased by over 30% between 2020 and 2025. Capital housing costs, however, are only one pillar of the structural squeeze. A secondary, equally aggressive extraction mechanism developed within the corporate insurance and local tax systems. As property valuations surged, local governments adjusted tax assessments upward, raising property tax bills by an average of 19% nationally between 2021 and 2025. Simultaneously, climate risks and extreme weather events forced property insurance providers to recalibrate their actuarial models. Insurance carriers raised premiums dramatically or withdrew from entire state markets, including Florida, California, and Louisiana. In Texas, average annual homeowners insurance premiums rose past $4,000, while Florida saw average premiums top $6,000. These non-mortgage costs added hundreds of dollars to monthly escrow payments, erasing the fixed-rate stability that existing homeowners relied upon. Transportation costs followed an identical trajectory due to supply chain realignments and corporate business model shifts. During the semiconductor shortages of 2021 and 2022, major domestic auto manufacturers made a strategic decision to alter their production lines. Instead of manufacturing affordable sedans and entry-level compact cars, auto companies shifted capital toward high-margin trucks, full-sized SUVs, and luxury vehicles. The average price of a new vehicle crossed $48,000, while the average used car price rose above $25,000. To finance these elevated prices, lenders extended loan terms to 72 and 84 months, increasing total interest payments over the life of the loan. According to data from the Federal Reserve Bank of New York, auto loan debt reached $1 to $6 trillion by 2025. Concurrently, auto insurance costs surged by 26% in a single 12-month period, driven by the complex electronics and sensor arrays embedded in modern vehicles, which made basic repairs vastly more expensive. Today, the average monthly cost to own and operate a new vehicle exceeds $1,000 when accounting for loan payments, insurance, fuel, and routine maintenance. The labor market offers no relief from these compounding overhead costs. While headline unemployment numbers remain low, real wage growth has failed to keep pace with the structural costs of living. Bureau of Labor Statistics data confirms that while nominal wages grew by approximately 20% between 2020 and 2025, the cumulative price increase for essential services, housing, healthcare, childcare, and transportation exceeded 32% over the same period. The net result is that workers are transferring a larger percentage of their gross income directly to fixed operational expenses, leaving virtually no discretionary margin to build savings or absorb financial volatility. The daily operational friction experienced by households is not merely the product of market forces. It is the direct outcome of an escalating systemic conflict between corporate revenue models, state regulatory mandates, and individual financial solvency. As basic living expenses outpaced wage adjustments between 2021 and 2026, the modern economy developed alternative shadow mechanisms designed to harvest liquidity from an increasingly strained population. The first major structural clash occurs in the sector of essential consumer debt and retail credit mechanics. Federal Reserve Bank of New York data confirms that aggregate U.S. household debt reached a record $18.79 trillion in early 2026, with outstanding credit card balances standing. The result is a system where interest payments function as a mandatory, inescapable monthly utility bill for nearly half of all adult Americans. A parallel crisis has unfolded in the market for early childhood care and family infrastructure. According to the Department of Labor and National Childcare Cost Surveys, the average cost for center-based infant care reached $1,230 per month in 2026, with major metropolitan centers like New York, Boston, and San Francisco recording monthly fees between $1,900 and $2,400. The U.S. Department of Health and Human Services defines affordable childcare as costing no more than 7% of a family's annual income, yet current market rates consume over 20% of the median dual-income household's earnings. Yeshuaddin cost barrier has forced a quiet structural breakdown in labor force participation. When childcare costs equal or exceed the net post-tax earnings of an entry-level or mid-tier career, one parent, disproportionately women, is forced out of the traditional workforce entirely. Alternatively, families turn to shift stacking or the gig economy to cover the deficit. This reliance on non-standard employment has created an entire secondary labor force operating without employer-sponsored healthcare, paid leave, or retirement matching. The corporate response to this labor market tension has been the widespread expansion of the platform-based gig economy. Over 30 million Americans now participate in independent contractor platforms to supplement primary incomes or bridge monthly cash flow gaps. However, investigative analyses of platform algorithms reveal a systematic transfer of capital risk from enterprise operators to individual workers. Platforms display gross earnings that obscure the real costs of vehicle depreciation, fuel taxes, private commercial insurance, and self-employment payroll taxes. When fully calculated, the net hourly wage for rideshare drivers and delivery contractors frequently drops below local statutory minimum wages. The worker essentializes the immediate cash injection to meet a pressing bill, while unknowingly liquidating the long-term capital value of their personal assets. The healthcare finance system represents a third major arena of institutional breakdown. Despite high overall employment levels, medical debt remains the single leading contributor to personal bankruptcy filings in the United States. Private health insurance plans have systematically shifted financial risk onto policyholders through high-deductible health plans. The average family deductible under employer-sponsored health insurance exceeded $3,800 in 2025. Consequently, even fully insured workers routinely face balance billing claims, out-of-network facility charges, and unpaid medical bills that are rapidly sold to third-party collection agencies. The systemic conflict between profit-driven healthcare providers, consolidated insurer networks, and patient solvency has created a reality where medical treatment functions as an unexpected financial catastrophe. Municipal finance policies have further compounded these pressures. Facing mounting infrastructure maintenance deficits, unfunded pension liabilities, and rising operational expenses, local municipalities across the nation have turned to aggressive fee-for-service models, utility rate hikes, and regressive sales taxes. Water and sewer utility rates increased by an average of 34% nationwide between 2020 and 2026. Municipalities have also increased code enforcement penalties, parking tariffs, and localized property assessments, effectively redistributing the tax burden onto fixed-income and working-class residents who lack the mobile capital to relocate. This multi-front economic squeeze has created a profound structural dead end. Households are not failing due to individual moral lapses, lack of discipline, or financial illiteracy. They are failing because the structural cost of maintaining basic human existence, housing, transportation, health, and child supervision, has been intentionally decoupled from the wage structure of the modern economy. Every efficiency gain achieved by corporate automation or financial engineering over the past 2 decades has accrued to capital returns, while operational overhead has been pushed entirely onto the individual consumer. The system is operating at maximum extraction efficiency, leaving millions of productive citizens locked in a permanent state of precarious survival.